In this video, we will talk about the danger of SBC, stock-based compensation, when analyzing companies. If you don't know what SBC is, you can fall into terrible traps and you may make many mistakes. SBC is quite important, and in this video I will show you a lot of value, plenty of examples, real life companies. I will show you some graphs, I will explain how important the SBC is when you analyze a company, when you value a company, because if you are wrong in your analysis of SBC, that can end up killing your performance. Frankly, killing your performance, because that's a huge mistake that you can avoid if you watch this video. And if this is the first video you watch from this channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year, investing in great stocks and taking into account the SBC. So we can start. I don't know how long this video will be, so take a glass of water, take your time, and let's start with some examples. The danger of stock-based compensation, SBC, when analyzing companies. I will take a look at several companies in this video. The first one is Snowflake. So you maybe know what Snowflake is. Let me read this description from Guru Focus so everybody understands what we are talking about today. Snowflake is a fully managed platform that consolidates data hosted on different public clouds for centralized analytics and governance. Okay, tech company, cloud company. If you look at the performance, I mean, the stock has been public, the company has been public since 2020, right? And fun fact, the team from Warren Buffett invested in this one during the IPO. If you look at the revenue, look at this, that's the blue at the left, up and to the right, that's wonderful. If you look at the EBITDA, that's bad. If you look at the net income, that's bad. Okay, now what I want to show you is this. You will see the free cash flow here in blue. When the company became public in 2020, they had a negative free cash flow. Look at this in blue. And then over the years, the situation improved, the efficiency improved, and the company created some free cash flow. So if you go on their financials, I'm using this website, Stock Unlock. You can check it. There is a link in the description below if you want to try it out. There is a discount if you use my link. If you go to the free cash flow for this business, you see that at the beginning it was not that great, and then you had an inflection point, and everything is happy again. Everybody is happy. That's fine. Now, here is the problem. If you don't know what to do in this situation, you will, this video will give you a lot of value. Looks profitable on paper with $900 million of free cash flow. Yeah, roughly 900 million. Look at this, 800 million, 900 million, $700 million of free cash flow that you can generate. So if you only look at the free cash flow like this, you may fall into this trap. Be careful now. But after you subtract the SBC, stock-based compensation, they're actually losing $500 million per year. Let me show you something that will shock you. This is the free cash flow, right? Positive. And then you remove the SBC, and Stock Unlock is a great website because you don't have to do anything. This is your line. You have a line, free cash flow, excluding SBC. If you click on this one, the chart will be very different. The chart is never in the positive territory. It's always burning cash. So if you take into account the free cash flow excluding the SBC, the company was never making a profit, never generating a free cash flow. Now, for those who are new to this business of investing, what is SBC? What is stock-based compensation? Maybe I should have started with that. I agree with you. The SBC, the stock-based compensation, that's a form of salary. That's stock options that you give to employees. That is a real salary that you give to people, but not with a real cash, real capital that is given to the employees' bank accounts. So how do you manage that accounting-wise? It's a minus in the income statement. So that's taken into account. The income statement is fine. But because it's non-cash, you have to add it back on the cash flow statement. So SBC is a minus in the income statement, but that's a plus in the cash flow statement. And that is added back to the cash flow from operating activities. I understand why not everybody really understands the mechanics behind this, but this is how it plays out. So a lot of people are falling into this trap of not accounting for the SBC. SBC, that's a form of salary that is a plus, an addition to the cash flow from operating activities. And if that's a plus to the operating activities, that will be a plus to the free cash flow. And that's the reason why Snowflake has a positive free cash flow. Now, if you deduct the SBC, if you are being conservative and you don't adjust for this stock option special treatment, you have this line, free cash flow excluding SBC, and this is totally different. You may see Snowflake and say that they generate some healthy free cash flow, but that's completely fake. So now officially the company generates a free cash flow, so they will have a price to free cash flow that is at 95 here. So still expensive, but still you have a price to free cash flow. Now if your real free cash flow is negative, how do you value Snowflake? That's a different game that I don't like to play. How do you value a company that is destroying free cash flow every quarter? This is it. You are literally burning $500 million of cash every year. Look at this on a yearly basis. You have this. Yeah. Absolutely a strong way of destroying value for your shareholders. So that was the first example of a company that officially generates free cash flow. But if you take into account the SBC, it completely destroys free cash flow. Now I want to talk about another example, Intuit. So you may know this company. This is something software accounting, very profitable. Growing quite fast, actually. Let me read the description. Intuit serves small and mid-sized businesses with accounting software, QuickBooks, and online marketing platform MailChimp. Very good. If you look at the financials, you will see that the revenue is going up, the net income is going up, the free cash flow is going up, and you see this line, stock-based compensation, in pink. Something will happen and something may disappoint investors. Intuit has a solid free cash flow. But when you remove the SBC, the growth rate for free cash flow drops from 13% per year to 11% per year. So that's a huge difference over time. Let me remove the Snowflake tab. Let me use Intuit. So I'm on Stock Unlock, same website, Grip website. I'm on financials. I'm on cash flow here. And you can check the free cash flow, this line. This line you have for the past 20 years, since July 2004, 20 years, you have roughly 13% growth rate for free cash flow. Now, if you look at this line, free cash flow excluding SBC, you go from 13% per year to 11.5% per year. So that's almost a 2% difference over time. So if you take into account this on your DCF, you make some big mistakes, I would say this way. You go from 13 to 11, that's a 2% point. And if you take into account the 2% difference, is the valuation warranted? I'm not sure for Intuit. And you have plenty of other examples of companies that go from 15% per year of growth rate for the free cash flow, from 15% to 10%. That's a huge difference. 5% is huge. For 1 year, doesn't make much difference. For 3 years, it starts to compound. For 10 years, it's huge. Only 2% makes a huge difference for your performance, I'm telling you. So now you have a price to free cash flow of 35. Would you pay your price to free cash flow of 35 for a business that grows the free cash flow 13, 15% per year? Yes, maybe. Would you pay your price to free cash flow of 35 for a business that grows 10, 11% per year? I'm not sure. Intuit is an example, but you have other examples with a wider gap. Now I can show you other examples and the opposite side. what you want to see in investing. The first company I want to mention is Fortinet, so cybersecurity company. They have healthy numbers. The official free cash flow margin is 31%, and the adjusted margin, if you take into account the SBC, is 27%. So the difference is not that huge. I'm not talking about growth rate, I'm talking about margins here. That will be very different if you look at Intuit or Snowflake. So very minor impact and still strong. And I can show you what I mean. This is Stock Unlock. This is Fortinet. This is the financials. If you look at the free cash flow here, if you look at the past 20 years, you have a CAGR, compound annual growth rate, of 26%. If you take the free cash flow excluding the SBC, you have 26%. No change at all for 20 years. This is what you want to see. This is exactly what you want to see. A strong company that generates a lot of free cash flow without having a lot of SBC. This is a sign of a healthy business that is not paying huge salaries as a form of stock option to employees. Another example I have for you is Booking, Booking.com. Very clean. SBC barely impacts results. The free cash flow margin goes from 33 to 31%. So roughly the same and a very profitable business. By the way, if you want help with your portfolio and improve your returns, click the link in the description to book a free strategy call with me. We will see how we can work together to grow your portfolio in the long term. So what we can say just on these 4 examples, we can say that Fortinet and Booking are better businesses from an investing point of view because they don't adjust as much the numbers as Intuit and Snowflake. Snowflake, that was a huge difference, you saw. Next point, always adjust the free cash flow by subtracting the stock-based compensation. Obviously, if you are watching this video and you are currently analyzing a stock, a business, please do this exercise of comparing the real free cash flow and the free cash flow with SBC. So the fake one, the real one, the adjusted one, and the non-adjusted one. Never trust the headline numbers blindly. Yeah, an additional tip for you guys. Sometimes you will analyze businesses, you will read the newspapers, you will read the reports, and you will go to the investor presentations for a company, for a public company. In the investor presentation, they will show you some graphs. They will show you some numbers. Be careful what the numbers are. Be careful if they talk about adjusted numbers, taking into account the SBC, or not. Some companies are honest and say, this is our free cash flow margin, but if we adjust for the SBC, we are a little bit less profitable. Management is aware of this problem. It's honest. It's okay. Deal with it. But some other companies are not honest and they never mention the real free cash flow excluding SBC. That's a sign that maybe the management is dishonest and doesn't want the best for you, the shareholder. Because if you don't take into account the SBC, that means you don't take into account the dilution. That means they don't take into account the per share metrics for shareholders. That means they don't care about you, the shareholders. That's a little bit extreme, but for some companies, that's how it works. Second tip for you, you have plenty of tips for this video. And I mean, these are tips that are actionable. You can use it right away, right now, today. Another way to check if you have SBC dilution, if they think about you, the shareholders, if they want to reward the shareholders, etc., is to check the incentives of management. So you go to a report called the proxy report, proxy statement for a public company, and you check the long-term incentives for their bonus. So if the CEO performs well, he or she has a bonus. These metrics are what, basically? The bonus she or he will get is based on what? On the revenue. If the revenue is growing, you get a nice bonus. On what? On the net income. If the net income is growing, you get a fat bonus. On what? On the free cash flow. So without the adjustment, on the free cash flow that is boosted a little bit by the SBC. So actually having more SBC is increasing your free cash flow. Or what? A good way to have a nice incentive that shareholders will like, that everybody will like, is an incentive based on a per share metric and the free cash flow adjusted with the SBC. So that's a lot of adjustments. And you have some companies that fit this criteria of being very honest and with the incentives that are aligned. You don't have a lot of them, to be honest, but you have a few of these golden companies with smart management teams. They know exactly what they are doing and they will reward shareholders. If you want to outperform the market, I would say that you have a better chance of achieving your goal of outperforming the market if you align well with management teams. If you only invest in companies that care about you, the shareholder. Yeah, let me continue, and I have another example to show you. That's the price to free cash flow of Meta versus MasterCard. Yeah, that would be pretty interesting. I've not seen a lot of videos about this one. I'm on Stock Unlock again. There is an affiliate link in the description if you want to use it. I am looking at the PE ratio for Meta platforms and for MasterCard. Meta platforms, so Facebook, is in green. MasterCard is in blue. Okay? Since the monetization ramp up of Instagram or Facebook, Instagram, you always had MasterCard that was being more expensive than Facebook. The blue line, MasterCard, is higher than the green line, Facebook, Meta platforms. And let me check the price to free cash flow. If you look at the price to free cash flow, roughly the same thing, right? You always have the blue line higher than the green line. You always have the blue line, MasterCard, being more expensive than Meta platforms, the green line, okay? And now the gap is a little bit closer now, narrow, but you always had MasterCard being highly valued. But Stock Unlock is smart, as I told you. So you can actually check the price to free cash flow, excluding the SBC. So that's the real price to free cash flow a company has. Maybe that's a better way of valuing businesses. And if you look at this, that's a totally different story. For most of the years, the valuations from MasterCard and Meta platforms are roughly the same. You don't have a gap that you had in the past with the normal free cash flow. Look at this. For a lot of the years, the valuations were very similar. Then in 2022, 2023, you have a gap because the stock price of Meta platforms dropped like a rock, okay? And this has a disruption, the free cash flow dropped like a rock, okay, very well. And now, what do we have? You have a company. I'm using this date. Starting point is the end of 2023. Now, Meta platforms has a price to free cash flow, excluding the SBC, of 50. That is higher than MasterCard at 38. I can show you the price to free cash flow that we had before. This was the price to free cash flow that we had before. So Meta had the price to free cash flow of 33. So if you don't take into account any adjustments, the normal price to free cash flow that you will find on most financial services websites online, you will find 33. You will say, okay, a little bit expensive, but this is warranted because this is a great business model. Okay, very well. Now, if you take into account the price to free cash flow, excluding the SBC, that's a different story. You are already at 50. And if I play around with the numbers, what do I have? Yeah. You had several instances where Meta platforms was more expensive than MasterCard. 2020, here that's a little bit different. And today, 2025. And I can show you something better for you. If I only look at Meta platforms, not comparing it with MasterCard, and I look at the difference between the price to free cash flow in blue and the price to free cash flow, if you take into account the SBC in green, you see there is a wide difference. The wide difference. Now, you have that's a 20 points difference, 15 points, 20 points difference. That's huge. And I would argue a lot of tech companies from the Silicon Valley have the same mindset of paying a lot of stock options. So be careful when you take into account the valuation. Sometimes businesses are not that cheap as you think. So I would argue that MasterCard and Meta platforms are roughly the same valuation. Oh, sorry. I would even argue that right now, at current prices, MasterCard is cheaper than Meta. It's something you don't hear often online. You don't watch a lot of videos talking about this one. Okay. Next point. If the SBC is bigger than the free cash flow, the company is not truly profitable. Real cash matters, not accounting tricks. You remember when we talked about the Snowflake? Snowflake had a lot of free cash flow, but if you remove the SBC, you have a big gap. Well, in this case, SBC was bigger than free cash flow. And I can show you on a free website how to check this for yourself. You go to Guru Focus. I'm taking Snowflake as an example here. You scroll down, and you check this. Look at this, the free cash flow in blue. And you put the toggle on in pink, the stock-based compensation here. So you can see the free cash flow in blue, the stock-based compensation in pink. You see that the pink is bigger than the blue. So the SBC is bigger than the free cash flow. That means the free stock options that they give to employee is bigger than the entire cash they generate for the business. Talk about incentives, right? So not the best incentives for shareholders. Let me put it this way. Let me continue. Companies with low SBC relative to cash flow are much safer investments. You see, we've talked about MasterCard. You have almost no difference between the price to free cash flow and the price to free cash flow excluding the SBC. Look at this. MasterCard, the blue line and the green line, that's roughly the same. So you don't have any difference. They don't have a lot of SBC. They don't have free stock options that they give to employees. This is safe. This is clean. And I like it. So focus on real margin, not inflated numbers. Yep. High SBC companies often look cheaper than they really are. I have already shown you Meta platforms. Also, Snowflake is a good example. I would argue that Google fits also in this category. And if you don't want to do it because you're lazy, let me show you how the numbers are. Okay. And for Google, you will see you have the same thing. You have a lot of SBC. Yeah, this is it. So this is the difference, right? Okay. In blue, that's the price to free cash flow. Now, as I'm recording this video, the price to free cash flow for Google is 27. Okay. And now if you take into account, if you adjust the SBC, the price to free cash flow is becoming 41 in green. The green line is always higher than the blue line. So the real free cash flow you get as shareholders is not that high. As I told you, high SBC companies often look cheaper than they really are. Adjusted valuations reveal the truth. So actually, Google has a real price to free cash flow of 40. That's a little bit expensive, not excessively cheap, not excessively expensive. The company is high quality. So yeah, just maybe the drop is just because that the valuation was high. Yeah, you have worries now about AI and ChatGPT, etc. Maybe the premium was not warranted. We will see. Nobody knows for Google. That's a side story. But very interesting to see the difference, the gap, if you take into account the adjustment. Okay. Strong businesses stay profitable even after adjusting for all costs. I have shown you MasterCard. Yeah, that's a strong business. Booking.com, Fortinet. You don't have a lot of adjustments. The businesses are still strong. Even if you make all the adjustments you want and you deduct all the fake costs, fake profits, fake cash flows, this is still a very profitable business. That's the kind of company you want to own long term. First, because if you invest in MasterCard, Fortinet, they are less likely to lie. They are more likely to care about the shareholders. they are more likely to reward the shareholders, and they are more likely to be honest with you, the shareholders. These are the kind of companies you want in your portfolio. Is it the end? That's the end. Yeah, you have plenty of value on this video. You can watch it twice if you want. These are very good examples, but I'm sure you get plenty of other examples online. Be careful of the valuations for companies with a lot of SBC. If you like this video and want help improving your portfolio, click the link in the description below to book a free strategy call with me. We will review your situation and see how I can help you get better results over time.